today, so I'll try and keep it as concise as possible. First of all, for any of those who stuck around late yesterday, had a really big story hit after the European close. The main chart I'm sharing with you at the moment is the Euro chart. You can see at the moment on the session we're trading mildly higher. The dollar's a little bit softer today after a pretty decent rally overall yesterday. But the euro, the move we're focusing on really is this big pop to the upside that we had. It's around 4:45, 5 p.m. that came last night. You can see here we rallied all the way up from 111.89 to an eventual high that was seen at 12.75. Now, just looking at that on a bit of a shorter time frame, you can see here you had an initial blast higher, a bit of a pause to the move before then the news started to circulate, and then we saw another push to the upside. So what was the news? And it was very surprising, which is why it caused such a massive move to the upside in such a short time frame. So the news story was this. This was the headline that got snapped on Bloomberg at that time last night. The ECB said to build taper consensus as QE decision time nears. Now, this is the key word. If there was any type of algorithm if I was to write it myself, that would definitely be the most flagged number in my system to be as a buy euro signal, given how dovishly we are generally placed on the timeline of ECB monetary policy, which of course is to expand the QE program, certainly not start to remove it. That's completely against what the market is kind of placed for at this present point in time. And granted, we've had the likes of the Fed, they've conducted tapering a long time ago. They've already hiked interest rates back in December. The Bank of Japan have done their subtle way of doing tweaking, which could amount to, some would argue, tapering of their policy, given the fact that there's less bonds are now eligible to buy, given the mammoth size of their program. So it's not, I'd say, out of line of some of the other global central banks, but certainly this is completely against consensus of how the market, what it's expecting. The interesting thing here was that, well, a couple things for the new guys to distinguish. So the actual comment itself was that the European Central Bank will probably gradually wind down bond purchases before the conclusion of QE and may do so in steps of 10 billion euros a month, according to an unidentified Eurozone central bank official. So an informal consensus building among policymakers in the past month that asset buying will have to be tapered once a decision is taken to end the program. Again, most logical step that people have been talking about is an extension of the existing program beyond the end point of March 2017, but they've got to tweak that somehow to have the number of eligible bonds to buy to continue buying thereafter that deadline. And so this is why this is surprising. This is basically suggesting then they're going to start reining it in, i.e. they're going to stop and the removal of QE is going to begin. And that's the word what tapering means. Now, this obviously has had a net negative effect as well in terms of the initial reaction in equities. If we just look back, that was when the comment hit. This is the DAX future you're looking at. That's when the comment came out. We've had a bit of a move lower after the initial open in the futures market this morning. But we've stabilised overall. The sell-off's been fairly contained thus far. Obviously, this is seen as hawkish, i.e. it's a net removal of a more accommodative stance from the ECB. Now, what I wanted to do was show you the Bund as well. Now, this is the Bund move that we had on the back of the announcement of those source comments last night. Now, first of all, let's just deal with this from a news perspective. This was a source. Now, there's a difference between sources and rumours. A source, let's say that I'm aware of the inner workings of how the journalists operate. And so each individual major newswire, Bloomberg, Reuters, Wall Street Journal, they will basically have either one or two select individual journalists. They tend to be people who've been in the market, a little bit matured in their career, and essentially they're just paid, their sole job being from every now and again, once a month, once a quarter, they will meet up with their undisclosed contact from the central bank in order to get an inside scoop. Now, this is beneficial twofold. For the newswire, obviously, they want to snap the big breaking news story that creates the most market moving impact on prices, because therefore you have to subscribe as a trading firm to that terminal to get that news first. Otherwise, you're going to miss these opportunities, or you're going to get caught on the wrong side of a trade. Secondly, the central bank actively goes out to seek these contacts within news agencies. Now, if you were the ECB, think of it this way. The market is prepped for you to be continuing to be dovish in the near to medium term, i.e. going to 2017. The market's looking for tweaking of policy and QE. If you wanted to test the water to the market's reactions to any potential stopping of QE or not following through on the dovish nature of what they've been intonating through their communication, why not, instead of officially saying it from a qualified ECB central banker, why not just leak it to the press? And this doesn't just happen. It's not just they pick up the phone and call a random journalist. This is a secured relationship that the central bank will have with one specific person who works for one of these big news agencies. And then they will use that journalist to then feed in a message that they want to deliver to the market. So a source is a qualified, I would say, piece of information. That's what's different to a rumor. A rumor is pure speculation. A rumor is a trader on Twitter making up something. Now, you can give that whatever level of credibility that you want. But for Bloomberg, their own source is normally a verified source. You know, they're not going to just pick some guy off the street, what do you think about QE? This is definitely going to be someone with inside thinking of the central bank itself. One of the things then, the Bund came under aggressive selling pressure here, but what I really wanted to show you was the US T-note. Now, this is treasuries, and if you look at my timeline on the bottom, let me just move this chart over. This is the year of 2013, and this is the US T-note. Now, I want you to look at from around May time down to, well, really this tracking lower all the way down to what was the end of the year. We went from around 134 down to 123. Now, for you guys who say to me, you know, you run over to my desk, oh my God, T-notes have moved 5 ticks. They've moved 5 ticks. This is gone from 134 to 123 in a year. If I was to show you just this 1 week in June, it went from 130.18 to 126. We went 4 points, not 4 ticks, 4 points. Now, why did this happen? So a little bit of a history lesson for those who are newer in the market. Let's identify a couple of key areas of significance. May was really important, and a part of May that I want you to look at is this part. So you can see that first circle. That was the 22nd of May. This was when Benjamin Bernanke was head of the Fed. He introduced the idea for the first time that the Federal Reserve may start tapering back their QE3 program with the potential for this to begin in September. That was when he first intonated towards the words tapering. Then, that was in mid-May. That was followed literally a month later on the 19th of June by this candle. That one there that you can see. That biggest powerful move to the downside, that was when the FOMC statement came out officially for the FOMC meeting that month, and the Fed And Bernanke said the Fed could begin tapering its bond buying later this year. That caused a monumental rise in US yields because we had been in a period since the financial crisis of QE and various sections of large-scale bond buying. He's basically saying we're going to start pulling that back. And he's saying they hadn't actually started at that point, just that they would look to do it by the end of the year. And then on September, which is going down the timeline, this is when it actually started to occur. In September is when you had the no taper meeting. So I know Will talks about this a lot. This was the no taper. The market's expecting them to do something. He had said in June that they were going to taper. September came, they didn't do it. Treasuries then started to rise as yields came back down. But then by December, it became a reality. And the Federal Reserve announced that they're to begin tapering back their QE. And check this out. They said they were going to start with $10 billion reduction per FOMC meeting starting in January. 10 billion. Let's go back to that source comment that came out from the ECB last night. What was the size that they've been talking about in terms of the tapering of the ECB's bond buying program? Why not start at 10 billion? You know, these things, have a tendency for a precedent to be set. And, looking at the state of play, at that time, when the Fed began tapering in December of 2013, they started cutting by 10 billion per month to 75 billion. So the Fed purchasing at that time was at 85 billion. The ECB's buying at this time is 80 billion. Not trying to put too many ideas in your head, but certainly there seems to be some subtleties and similarities here between tapering and the way it's been done before by the Fed as a potential guideline. Just quickly going back to bunds. I mean, look at bunds since the financial crisis. It is insane. And I know a few months ago, Piers was talking about his fund manager friends that he was talking to, and they were talking about they remember having conversations when we were at 135 and you were like, oh, bunds are a sell at 135. That's no way they can go any higher. Meet up again a few months later. Bunds at 140. There's no way they can go higher. This QE's got to stop. Oh, it's ridiculous. Meet up again 6 months later. Bunds at 150. Bunds at 160. Bunds now at 170. There is no end to this. But ultimately, there does have to be some degree of pullback. And if we go back to the actual 2013, the intonation towards taper, the commitment in the FOMC statement to do it that year, and then ultimately that coming to fruition, that was an 8.25% decline in US T-notes. If the bund was to decline that kind of scale, well, let's have a look. If we were to decline 8.25%, I mean, really, it's a drop in the ocean, the amount that the bunds have rallied. Look at that. That's 8%. That only puts us back at 155. We rallied since the financial crisis. We were down at 115. So is it out of the realms of possibility that to see these types of pullbacks and these assets? I don't think it's unrealistic. The question mark now is how valid are these sources? They do seem awfully out there on a dovish scale. The one thing as well when trading this event, which is really important for you guys to learn, just going back to this Euro chart, because I know there was a couple of you that were still around at the time, was you get this, generally speaking, this explosive move at the beginning. Now what's interesting here is you had the big pop, then it kind of leveled out, then it went again. Now this is important because this came out after the European cash close. So news dissemination of a European headline or European related monetary story, from my experience, is always slower for the market to react. That's because it's the US trading European policy, of which inherently they're just not as quick at trading it itself. This could have also had a second effect. Maybe the ECB communicated to Bloomberg to drop it after the European Open. If I was being a little bit more conspiracy about it, I'd say, well, you want to really avoid Deutsche Bank being live trading in the cash market if you wanted to test the water to see how the market might react to a hawkish comment. If this came out during the European trading hours, I think that the move, possibly the impact of the move would have been different, because I think Europe might not have bought into the story so much. But in US trading hours with US traders, they're looking at the headline for just what it is, and they certainly pushed it higher. It circulates, disseminates across other news wires and brokers. The move gets a second wind. But whenever there's a source comment, and this is regardless of whether it's ECB, whether it's OPEC, whatever it is, the first thing I think is, when is the rebuttal? Having known people who work at Bloomberg, if you work at Bloomberg and you snap a headline, if you work at Reuters, your boss at Reuters is giving you an absolute earful going, if you don't go out there and get me a scoop to rebut this or confirm it, you're going to get fired. And you need to do it in the next 5 minutes. So everyone at Reuters is going stir crazy, calling up everyone, calling up all their contacts. The thing I'm waiting for then as a trader or an analyst is I'm looking for, does this get denied? And you've seen this over and over and over again. One newswire will run a source, the market sees a phenomenal move. I'm looking for, possibly, when can I reverse that on the back of a denial? Particularly when the news like last night is so far removed. It's so far removed from consensus. The other interesting thing here as well, just I guess from a psychological point of view on price movement, is I don't think it's any real surprise for me that the market is heavy long on momentum buying into the euro. And then where do they push the price point? Well, it's the natural human intonation to find a big red line in sand with the R1 on the day, and they took it all the way to that point, and then everyone takes profit on that long. So just a couple of kind of pointers there, I guess, from a trading point of view. Moving on though, obviously there's much more to get through, and I'll try and whip through this as quickly as possible. The one thing that we have seen, this chart I just thought was quite funny. November interest rate hike probability in the US. Now, if you remember, everyone has thought there's no way the Fed can hike interest rates in November because of the close proximity of only a couple of days from the US elections. However, if you were to listen to Lacker, if you listen to Mester more recently, even Evans, who spoke overnight, all being very hawkish, in fact, saying that November is very much a live meeting. If you were looking at the Fed Fund futures probability of a 25 basis point hike now in November, we're actually just above 20%. Now, when we went into the September meeting, everyone was talking about, although the market's priced low, maybe it's 50-50, that Fed Fund futures in September were actually lower. They were more like 18-15%. So we've now got a higher probability now for November than we did previously for September, which I think is incredible. I still do not think that they will do anything in November, but just interesting to see that that has been creeping up. And certainly from a December point of view, this number keeps moving higher. The CME figures at 55, the Bloomberg figures just a touch above 60% now priced in. Moving on. One of the other things, though, obviously this is all intonating towards a hawkish Fed. Now, this is important, particularly for the gold market. And the gold market saw a really nice move to the downside yesterday. It was, supported by fundamentals and technicals, which saw a combination of which a powerful move to the downside. I think I read a stat, it was the biggest one-day move for gold futures in 18 months. You can see here, first of all, from a technical perspective, in the run-up to Brexit, obviously you had the resistance level felt in May, again, just pre the actual vote in mid-June. Then Brexit happened, and obviously a massive uncertainty in the market globally. Gold rocketed higher. And then that previous resistance then turned support in terms of through August 2016. We then had a dovish Fed on that September hold and the dovish dot plot projections. Gold took another lift. But yesterday, significant because we broke not only that low and that high from pre-Brexit, but 1300 just psychologically is a big level for the market. And then since that broke, we've continued to see downside. Now, a couple of things I've read this morning still are questioning the validity of this to be able to go all the way back down. If you see it, there's a very defined level on the downside, that 1200, that firm bounce that we're seeing at the end of May. Could we get back down there to 1200 in the near term? I do not think so, because of the looming political risk, certainly from the US first and foremost, but then you've got to couple that with the Italian situation in October with the referendum and the reform bill. There's more politics issues to come for Germany as well into 2017. The possibility of Trump, so on. So downside from here, probably I'd say next target will be that initial level on which we were looking at, which is more akin to 1250, if anything. I think that inherent risks on the short to mid-term horizon will stop any aggressive sell-off down to 1200, at least for the time being, unless the situation changes. So gold, obviously very interesting, but a short does come with some risks as we get lower towards 1250, I feel. Okay, quick look at some other things. Just looking at crude oil. Obviously, API crude oil inventories came out last night. A couple of interesting stats. After 4 weeks, 1, 2, 3, 4, you can see here the red bars of drawdowns. Expectations were for a 1.5 million inventory build in the headline. But the API has reported yet another shockingly large drawdown of 7.6 million. So we had a drawdown, let me repeat, in the headline figure, a drawdown of 7.6 million. The market was looking for a build of 1.5 million. Cushing, 400,000 against expectations of 100,000. Gasoline, a build of 2 million. That's pretty punchy because the market was only looking for a build of 500,000. Distillates, a drawdown of 1.3. So the other numbers, gasoline a little bit, but the crude headline will take focus this afternoon because the crude headline deviated so far from consensus, where the other numbers were much more around their mean, if you like, of what was broadly expected. So you're going to have to watch that headline in particular. It's worth noting that 5 weeks now of crude draws comes at a seasonally building time of year. In terms of builds, we're more accustomed to seeing at this time of year. So what effect has that had on crude oil? Well, let's quickly take a look. This was the move last night. So as you know, it comes out shortly after 9:30. That was enough then to get us above that kind of high print that was holding some of the price action on the 3rd and yesterday in terms of the afternoon session. And here we are again. This is often what you see. If you have a really big outlying number in the APIs, quite often you get the initial first reaction that you can see upon release. Then we kind of go sideways during Asia. Let's not forget Chinese markets are also closed, so market activity overnight is lessened for Golden Week. And then Europe and UK come in, and then lo and behold, at 7 o'clock, as soon as we start arriving at our desks, we squeeze in another 50 cents or so, 40 cents on the back of that. Now that does not occur after every API. What you're looking for, like I always say in terms of trading data, is an outlier far removed from what the consensus has been built into the market. This was such a surprise that then you get a secondary move when Europe come in. Obviously, if crude keeps moving higher, although this hawkish story, I'd say, is a net negative for, say, the DAX and Euro stocks, obviously if crude keeps punching higher, that is going to help some of the energy-related names, and it could counter some of the downside in what otherwise might be an outright short if there's DAX or Deutsche volatility, if concerns start to come about, and also the hawkish taper story that circulated last night. Quick look then, just to wrap things up at the calendar for today. We have had a series of service PMIs come out this morning. They've had little reaction in the market. That's because they're final readings. A quick look at the main countries. France, 53.3, below the expected 54.1. The German services PMI 50.9, slightly above the expected 50.6. And the whole European figure just coming in just through 9 o'clock then, 52.2, which is broadly in line with expectations. The one I'm concerned more about actually is the UK figure. Obvious reasons, we're a heavily sector-based economy. And look at the size of that last figure that we had in August. 52.9, expectations were for 50. And we got 52.9. That was an amazing leap from the depressed number we had immediately after Brexit in the July period. UK data, as we've seen, continues to remain strong. Some would argue continues to be remained by the weaker currency. But given the context of looking at cable this morning, any of you who come in early, I get in at about, shortly after 7 o'clock. If you do want to get in early, I think cable's opportunities are come early. Those who've come in, it's paid dividend because this morning, much like yesterday, repeat price action. I mean, look at this low that we had. Well, this was back on Monday. You had that low in the afternoon. Then you had the overnight low, and really it was the break then that came at 7 o'clock in the morning that caused the big flush lower to those 31-year lows. Then if you look at this morning's price activity, you had yesterday's low, yesterday evening or Asia Pac low, and then we've broken it again to the downside before we've had this reversal. Now this move here that we had this morning was totally on no news. This is purely the technical break of these levels. Much like you had here, it's happened again there. Obviously this move was larger because this was technically significant because of course, the 128.06 futures Brexit low, which was there, and that caused an extension of the selling pressure from yesterday. But again, technically led, and that also cemented by the fact that we bounced because there is no real fundamentals other than the overriding trend of hard Brexit. Obviously a negative trend I think will definitely, even though this has bounced in the intraday for the moment, an overall downward trend looks most plausible from here on out, given most people expect UK economic data to deteriorate as we go through into the latter part of the year. Just quickly, looking at some of the other data points for this afternoon, it's a busy day actually. In the afternoon you've got US ADP employment change. Now this is always an interesting number because historically people will look at it as a precursor for non-farm payrolls. Now this has been a very consistent data set, unlike non-farm payrolls, which has been a highly volatile number. So 181, 71, 194, 177 was previous. Looking at today's expectation is for 170. So again, pretty much in line with the recent pattern. I did see though an interesting graph from Deutsche Bank this morning, and they were looking at basically the variance between ADP and NFP has been pretty bad of late. I.e., this is ADP and NFP and how much is over and understated the actual Bureau of Labour Statistics report. If you want to get technical about it, according to Deutsche's calculations, one standard deviation of discrepancy between the two series is 56,000. The average absolute difference between the two series is lesser to 45,000. So again, I was talking to some of the month twos yesterday about how this data, how these economists formulate their median consensus estimates for payrolls. These are the sorts of things that they're looking at. The tracking of absolute and standard deviation differences between numbers can give you a bit of a guideline between whereabouts you think the labour statistics report will come out. And then finally as well, you've got ISM non-manufacturing. This also important today, not just for the headline reading, but because of two things. One, this data was particularly poor the last time. Now the Fed have continued to sound hawkish, and economic data since the dovish hold in September has been better than expected. Consumer confidence for one is riding at its highest since pre-financial crisis in the US. Durable goods has been good, and housing data has been strong, and so on. So we're looking for potentially then an ISM non-manufacturing bounce here today to validate that hawkish view that's really built into the market, that's weighed on the likes of gold prices in the last day or so. And also to kind of back what the Fed hawkish speakers have been saying. Now, the second important thing about this data today is the employment constituent. This is another thing of which, after the headline, the market will latch onto to formulate their idea about the strength potentially of non-farm payrolls will be on Friday. And then finally, you've got the crude oil inventories as discussed, but speakers, again, pretty busy. Just be careful. 9:30 alongside that service PMI from the UK. You've got Broadbent speaking from the Bank of England. You've also got Saunders speaking again at midday, Kashkari and Lacquer. So busy calendar, in-house guys, printed it all out, it's on your desks. Be vigilant around those times, and then just keep an ear on the squawk. Obviously, there's been a lot of rumours circulating on ECB sources, tapering. All these things are going to be the new news items that certainly I'm looking for, and so you should be doing so likewise. Okay, have a good session and enjoy your day. Thank you.